In 2025 and 2026, central banks across the US, UK, and Eurozone held interest rates elevated following the 2022 inflation surge, debating how long rates must stay high to break inflation. The last time this question was answered definitively, 1979 to 1982. This is that archive. This is an archive of the Volcker disinflation, documented Federal Reserve data from 1979 to 1983. Not a forecast, not investment advice. Chapter 1. The inflation of the 1970s. U.S. consumer price inflation reached its post-war peak at 13.5% in 1980. The causes were multiple and compounding: two oil price shocks in 1973 and 1979, expansionary fiscal policy, wage price feedback loops, and the removal of gold constraints after Bretton Woods 1971. Multiple Federal Reserve chairmen across the 1970s tightened and then eased before inflation was broken. Each partial tightening allowed inflation expectations to remain unanchored. By August 1979, the federal funds rate had reached 10.5%, but inflation was running at 11.3%, a negative real rate despite double-digit nominal rates. Chapter 2. The Volcker appointment and the new operating framework. Paul Volcker was appointed Federal Reserve Chairman by President Carter in August 1979. In October 1979, Volcker announced a fundamental change in operating procedure. The Fed would target non-borrowed reserves rather than the federal funds rate, accepting greater interest rate volatility in order to control money supply growth directly. This was not simply a higher Fed funds rate. It was a commitment to accept whatever rate the market required to squeeze money growth. The signal was that inflation would be broken regardless of short-term consequences for growth or employment. Chapter 3. The documented rate and recession path. The federal funds rate reached 20.5% in June 1981, the highest in recorded Federal Reserve history. It remained above 15% for over a year, from May 1981 through June 1982. U.S. GDP contracted in the first quarter of 1980 by 3.2%, recovered briefly, then contracted again in the recession of 1981 to 1982, the deepest recession since the 1930s at the time. Unemployment rose from approximately 6% in 1979 to 10.8% in November 1982, the highest since the 1930s. Chapter 4. The documented outcomes. U.S. consumer price inflation fell from 13.5% in 1980 to 3.2% by 1983. The disinflation took approximately 3 years from peak to the new low. The 30-year Treasury bond yield peaked at approximately 15.2% in September 1981. It then entered a sustained rally. 30-year yields fell for the next 4 decades, reaching approximately 2% in 2020. Chapter 5. The political and social cost. The recession of 1981 to 1982 contributed to Republican losses in the 1982 midterm elections. Volcker received physical threats and farmers drove tractors to the Federal Reserve building in protest. The Volcker disinflation established what became known as the Fed's inflation-fighting credibility. The demonstrated willingness to accept significant economic pain to restore price stability. This credibility became a monetary policy asset in subsequent decades. Chapter 6. The common observations. 3 documented high-rate disinflation episodes, 1979 to 83, the Bundesbank's handling of German inflation in the 1980s, and the post-2022 tightening cycle. In each prior case, rates remained elevated until CPI data confirmed the break, not when the forecast showed it would break. The Volcker episode documents a transmission mechanism. Breaking inflation expectations required positive real rates for a sustained period, not 1 or 2 quarters. The break came from credibility plus duration, not rate level alone. Chapter 7. What the historical record shows. This archive does not predict whether current elevated rates will produce a comparable disinflation. It documents the 1979 to 82 sequence: inflation entrenched, framework change, extreme rates, severe recession. Inflation broken. The archive stays open. This is what the historical record shows.